Welcome back, everybody. It's Westy, your bestie when it comes to all things personal finance. Today, we're going to be going over a super simple way that you can take a very brief look at a company and see if it's worth investing in. This is a very simple trick that one of my accounting professors at university showed me, and I've been using it ever since. So, I actually learned this little trick by pure chance. I went to my accounting professor's office hours and I asked him, "Hey, professor, you've worked for all big four accounting firms and you've touched more balance sheets, statement of cash flows, and P&Ls than anybody that I've probably ever met. Are you able to use that information and what you've learned to make better investments? And if you do, like, how do you do it? I want to have this edge on everybody else that's my age." And he said, "It is far simpler than you would actually think." My professor then proceeds to sit down at his computer and pull up marketwatch.com. And you can see that we're here right now. And he looked up Microsoft. So I'm thinking, okay, Microsoft, he wants me to buy Microsoft. Well, he scrolls down and clicks in the financial section, and it shows that they have their income statements, balance sheets, statement of cash flows, and their SEC filings. Well, he then says, all I look at is the 5 year trend on the right side, because you can see very easily, oh, look, sales, they're increasing. That's got to be a good sign. We then scrolled down and looked at gross income, which had been increasing, as you can tell by the little graph. And he turns to me and he said, "Do you know the difference between an asset and a liability?" And me, just about to graduate with my degree in accounting, I'm like, "Yeah, of course I do." And he's like, "Well, then you would know that having more assets is generally better than having more liabilities, right?" He then wrapped up by saying that he is in no way, shape, or form saying that I should buy Microsoft, but he was just saying that if you can find a company that's constantly increasing the sales volume that they have and constantly increasing the overall profit margin they have, you're going to have a very good company on your hands. Really appreciate it if you smash the subscribe button. I really appreciate it. It's super cool to have people following me on my journey through all personal finance things. So I'd appreciate it if you pressed like and subscribe, but let's jump right back to the video. If you are going to be looking at stocks by yourself and trying to analyze and see if it's something that you're interested in investing in, there are a few things that you should know before you jump into it, such as what is an income statement, a balance sheet, or a statement of cash flows, and what type of accounts you want to be increasing versus the type that you want to be decreasing. So the statement that we're currently looking at right here is an income statement, also known as a profit and loss statement, for the specified period, which obviously right here, there's multiple periods, but it shows your overall sales and then it removes the expenses to get you to your overall operating income. Then we have a balance sheet, which is basically taking a snapshot of the company at a given point in time. So in this case, we'll be looking at a balance sheet for 2019, 2020, 2021, 2022, and for 2023. So while we're looking at this balance sheet, there's a couple things that I'd really like to point out. First is obviously having cash increase, stay the same. That is totally fine because you want the company to be able to reinvest their capital into the company or pay it out as a dividend. And that's totally fine and normal to see. But something to keep in mind is your total accounts receivable. You can see here that it's increasing, and that can mean a couple of things: that people are buying more and they had a lot of sales at the end of the year and they just haven't had time to pay, or there's more people who aren't likely to pay. Another thing you can look at for that same reason is your bad debt or allowance for doubtful accounts. This, as you can see, it's negative, it's in red. This is called a contra account. It's basically just, it's on the asset side of the balance sheet, but it has a natural credit balance. So out of this $48 billion, $650 million is expected to not be received because of people not expecting to pay, clients going bankrupt, or various different reasons. Another account that I like to look at on a balance sheet is going to be goodwill. What I like to think of goodwill is that is the difference between the actual value of a company or an asset and what they actually paid for the asset. So if you're going to buy a computer that is worth $1,000, but you were to pay $2,000 for it, you'd end up having $1,000 worth of goodwill. If some of the company's acquisitions weren't made public or you didn't see them in the news, this would be a good place for you to see that they've made some type of acquisition. When doing your analysis of the liabilities, you should keep in mind that liabilities increasing isn't always a bad thing. When a company is experiencing rapid growth, they're typically having to finance that growth via debt. If you do decide to try to invest into singular stocks, there's one last thing that you should always keep in mind when choosing your companies, and that is overall market sentiment. If there's good or bad publicity for your company, that's really hard to see when you're looking at the financials. A great example of this would be Boeing or GameStop. Boeing is a very solid company, and there's very few companies that do what they do. But when you have parts of the planes being ripped off, that's very bad publicity, and the overall market will react to that. And on the other side, you do have things like GameStop, where you have people of Reddit get together and just pump the stock to the moon, as long as you have those diamond hands, am I right? But keeping that in the back of your head when you do go to make your investments is also something that I would recommend.
Thank you so much for watching, and if you enjoyed the video, make sure to press the like and subscribe buttons. And if you're interested in seeing what I would build as a 3 ETF portfolio, go ahead and click on the link.